Welcome back, everyone, for day two. We on day two, y'all, of our live series on business taxation. Today, we're going to be discussing the taxation of S corporations in very grave detail. Okay, so an S corporation is a corporation that has elected to be taxed as a pass-through entity. This means that the income and losses of the S corporation flow through to the shareholders' individual tax returns. I will repeat. S corporation is a corporation that has elected to be taxed as a pass-through entity. This means that the income and losses of the S corporation flow through to the shareholders' individual tax return. S corporations can be a good choice for small businesses that want to avoid double taxation. So let's have an overview of a quick overview of S corporations. S corporations, they elect special IRS status to be taxed like partnerships while enjoying corporate limited liability. What does that mean? What does that mean? There's no self-employment tax. So for federal filings, S corps submit Form 1120S for business income and deductions. Why? Why do they? What do y'all know what a Form 1120S is? Have y'all heard of 1120S? So you're able to file your individual on a 1040 and your business on 1120S as an S corp. But this is due on March 15th. K1s go to shareholders, okay? K1s go to shareholders. So a key benefit is single layer taxation. So income flows through to the owner's 1040, but reasonable wages paid to the owner or employees are subject to payroll tax. Distributions in excess of reasonable compensation are not subject to these taxes. You can optimize by taking lower salaries and higher distributions. Okay, let's look at we'll do some examples later, but I'm gonna do one little example. We're gonna do two or three case studies later. So let's look at let's say you got ABC Corp. They made 500,000 in revenue and 300,000 went to expenses. So the two 50-50 shareholders pay themselves 40K each in salary. The 80K is deductible wages. The remaining 120K is ordinary business income, and it flows through to the shareholders' 1040s on K1s. So it's reported on the 1040s via K1s. Okay, so reported on the K1 of the 1040. So they each report 60,000 additional individual income. Have you all heard of basis? Basis is very, very important when you're talking about S corporations. So basis calculation, never overlook basis. Please overlook basis. Shareholders can only deduct losses up to their outside basis, which includes capital contributions. So basis is also determined if distributions are taxable. Y'all, when we break down basis a little bit more? No problem. Basis is the value of an asset for tax purposes. It's used to determine the amount of gain or loss that is recognized when the asset is sold or exchanged. So the basis of an asset is determined by its purchase price, plus any cost incurred or to acquire it. So commissions, closing costs, okay? Commissions, closing costs, okay, basis. So those are assets. Let me give you an example. If you buy a house for $200,000 and pay $10,000 in closing costs, your basis in the house would be $210,000. So basis can also be adjusted for certain events that occur during the ownership of an asset, such as depreciation deductions or capital improvements. Here's another example. If you depreciate a house over 27 and a half years, okay, your basis in the house would be reduced by the amount of depreciation you've taken. The basis of an asset is important. Why? Because it's used to determine the amount of gain and that's recognized when the asset is sold or exchanged. So here's another example. Let's say you sell a house for $250,000. Okay? The basis in the house is $210,000. You will recognize a gain of $40,000. So let's talk a bit more about how S corporations work, okay? I just want to put y'all in the mindset, right? So this is how it's, so we talked about why, what is an S corp, why you need to claim it if you make over a certain amount of money as a business owner. To elect S corporation status, a corporation must meet certain requirements. 4 requirements. The corporation must have no more than 100 shareholders. The shareholders must be individuals, estates, or certain trusts. The corporation must not have any C corporation shareholders. The corporation must not have passive income that exceeds 25% of this gross receipts. So once a corporation has elected S corporation status, it must continue to meet the requirements in order to maintain its status. So there are a few different ways for a corporation to elect S corporation status. The most common way is to file Form 2553 with the IRS. So if you're filing sole proprietor or LLC and you make over, I think it's $60,000, and you wanna elect as an S corp, you want to switch your election to an S corp, no self-employment taxes. File Form 2553 with the IRS. Go ahead and do it now because it takes time. It takes time to switch over, okay? But S corp have so many perks. Not perks, just deductions, liabilities, okay? Lowered liabilities, increased deductions. Once an election is made, it is effective for the current year and for all future years unless the corporation revokes the election. So let's talk about the taxation of S corps. The individual and losses of an S corporation flow through to the shareholders' individual tax returns. What does that mean? That means that the shareholders report the income and losses on their own tax returns, okay? They pay taxes on their share of the income at their individual tax rates. S corporations are not subject to federal income tax. Y'all thought I was lying. However, they are subject to certain taxes such as employment taxes and the built-in gains taxes. Not self-employment tax. The built-in gain tax is a tax that is imposed on certain gains that are realized by an S corporation when it converts from a C corporation. Okay? S corporations can also be subject to a state and local income tax. Okay? Can't go around that. Those salts. Can't go around those state and local taxes. Okay? Sorry. Salts are not going anywhere. That's a SALT, state and local income tax. Okay, so how do S corporations? We need more information on how S corporations work. So S corporations, like I said, they're not subject to the same payroll taxes as C corporations. This can save S corporation shareholders money on their taxes. S corporations can have up to 100 shareholders, but there are some restrictions, okay, on who can be a S corporation shareholder. For example, S corporations cannot have non-residential alien shareholders. Did y'all know that? S corporations can issue different classes of stock. So this can be helpful for businesses that want to give different shareholders different rights and privileges. So I'm going to go a little deeper on the taxation of S corps. S corporations are not subject to the alternative minimum tax. This can save S corporation shareholders money on their taxes. S corporations can deduct up to $500,000 of losses in the first year of operation. So how can this, why is this helpful? Any business that are just starting out, this is very helpful for them to be able to deduct up to $500,000 of losses in the first year of operation. That's huge. S corporations can elect to be treated as a C corporation for 1 year. This can be helpful for businesses that want to take advantage of certain tax benefits that are only available to C corps. Corporations are subject to a number of restrictions on their activities. For example, S corporations cannot be a bank. S corporations cannot be an insurance company. And S corporations cannot be any other financial institution. They also cannot be a real estate investment trust. S corporations must file Form 1120S with the IRS. This form reports the income and losses of the S corporation, and it also reports the amount of income and losses that each shareholder is allocated. Okay. S corporations must also file Schedule K1 with the IRS for each shareholder. I'm going to say that again because I said it earlier, but I want you to know how to file. S corporations must file Schedule K1 with the IRS for each shareholder, okay? This schedule reports the shareholder's share of the S corporation income and losses. So one more. Let's go a little bit more on the taxation of S corporations. Then I'm going to do some case studies, okay? So S corporation shareholders are taxed on their share of the S corporation's income at their individual tax rates. What does this mean? This means that the S corporation's income is not taxed at the corporate level. S corporation shareholders are not subject to self-employment tax on their share of the S corporation's net income that's allocated to them as long as they're not active in the management of the S corporation. S corporation shareholders who are active in the management of the S corporation are subject to self-employment tax on the entire share of the S corporation net income. S corporation shareholders can deduct certain expenses related to their S corporation interest on the individual tax returns. These expenses include business expenses, interest expense, and depreciation. So I'm going to go over 3 case studies. So the first one is reasonable compensation, okay? So you got John. John is the sole shareholder of an S corporation that generates $500,000 in annual revenue. He currently pays himself a salary of $50,000 as the sole employee. However, a reasonable salary for his role should be closer to $100,000 based on industry standards. So by increasing his salary to $100,000, John reduces the S Corp's taxable income to $400,000, saving about $15,000 in self-employment taxes versus taking a $50,000 salary. So this case demonstrates determining reasonable compensation to optimize taxes. Okay. Told y'all the 20-minute takedown. We only in 15 minutes. We got 5 more. Let me see what I can get in these 5 minutes. Okay. The next case study, basis and loss deductibility. So you have Emma. Emma owns an S corporation and has $20,000 outside basis in the company, reflecting her capital contributions. In year 1, the S corporation generates a $50,000 loss. Emma can deduct $20,000 of the losses on her personal return based on her basis. So the unused $30,000 loss gets carried forward by the S corp. So in year 2, the S corp has $20,000 in income. So Emma must report the full $20,000 on her return despite prior losses. So because her basis is now 0, this case demonstrates how basis has an impact on loss deductibility. Last, distributions. So you got Bob. Bob is 100% shareholder in an S corporation with no corporation earnings and profits, with no C corporation. So he's 100% shareholder in the S corporation, and he has no C corporation earnings and profits. So in year 1, Bob receives a non-dividend distribution of $100,000, right? Reducing his basis to 0. In year 2, the S corporation earns $200,000 worth of income and distributes $150,000 to Bob. So $100,000 of this is taxable to Bob based on ordering rules. The first $100,000 distribution restores Bob's previously reduced basis. This case demonstrates the impact of distributions on shareholder basis and taxation. I did it in 17 minutes. Got 3 more minutes. Okay, I'm just playing. 20-minute takedown. Okay, so that's a wrap for our discussion of taxation of S corporations. Tomorrow, we're going to do a quick comparison to C corps. So S corps avoid double taxation, but C corps allow some deductions like benefits to reduce taxable income. I'm so happy to address any questions you have. Go ahead and put them in the chat. And I'm gonna start tomorrow out answering your questions because a lot of people are going to catch this on the replay. So I want to make sure I answer any questions. So if you got any questions or you found this information helpful, please comment in the chat. That concludes our lovely, lovely discussion of S corps. But before we wrap up today, I want to let you know that the doors of Express Tax Academy have opened, and starting September 1st, Express Tax Academy will offer more detailed courses on these business and CT topics and more. I'll be providing continued education credits for finance industry professionals as well. So in addition, I'm excited to announce my 10K in 60 days program for new and current tax professionals who want to fast track their business. This will include one-on-one. I hate that when it happens. This includes one-on-one mentoring and support from me. So if you're interested in advancing your tax preparation career through my academy or coaching programs, go ahead and schedule a strategy call with me today to discuss details and see if you're a good fit. Click this link right here. Click the schedule button to find a time that works. I cannot wait. I can't wait to speak with you soon and help you take your tax business to the next level. That's all for today's lesson on S corporations. See everybody tomorrow to dive into C corporations. Once again, please leave all questions in the chat and we will begin tomorrow with answers, because I know a lot of people are coming on the replay and I want to answer all questions. Thank y'all for joining me. I'm Tax Coach Erica, your favorite tax preparer's favorite mentor. See you tomorrow.